Hello, everyone. Thanks for joining us today for the GLCA's 2024 Spring Webinar. My name is Paul Casuccio. I'm the head of the indirect tax practice at Canada's largest law firm, Fasken. You'll be hearing from me again later on today's topic, but I did want to take a moment to briefly make some introductions to our topic and to my friends who will be speaking with us today. Although our topic couldn't be more current and timely, it was actually 25 years ago that I walked into a brand new class at my law school called the Taxation of E-commerce. There were only a few of us in that class, but there was already a lot to talk about. Now, fast forward a quarter of a century, and we're still talking about many of the same basic issues, but now we've got a lot of complicated law wrapped around those issues. I'm happy to be joined today by a panel of experts who are going to help us understand some of this complicated law that applies to those of you engaged in e-commerce transactions with China, Switzerland, the EU, and with Canada. We have a lot to discuss today, and so I'll let my friends briefly introduce themselves as they begin their respective presentations. First up, we'll be hearing from Yijun about the taxation of e-commerce transactions in China.
Okay. Hello, everyone. I'm Yijun Liu from DS Avocats. So DS is a French-based law firm with presence in several jurisdictions, including China. So here we have two offices in Beijing and Shanghai, and I am mainly based in Shanghai, and I specialize in tax, customs, and investment matters. So before I start, first, today I will focus on the cross-border B2C imports into China, because so far in China, the cross-border e-commerce is not yet open to B2B import. So secondly, the objective of my presentation today is to show you how cross-border B2C works in China since 2016 reform, because there are no really significant updates in recent years. And of course, how it will be taxed and which party will be responsible for what from a tax perspective. So, Andrew, can I have the control for? Yes, okay. So since years, China is one of the largest countries in terms of export and import through e-commerce channel. However, until 2016, there was no any established customs duty and tax regime dedicated to e-commerce import. So during that time, an online purchase of foreign products by a Chinese resident individual was not considered as a trade, but as an import of personal article, so which is of non-trade nature and was subjected to the parcel tax regime with certain flat rates. So under the parcel tax regime at that time, the levy of tax was not systematic and nor under the efficient control. So since the e-commerce became more and more important, so China issued in 2016 a series of regulations to regulate the e-commerce imports from duty and the tax perspective. So the main development was that these imports, where some criteria are met, would be treated as a trade of goods instead of import of personal articles. In addition, the regulation also established the tax withholding obligation for the e-commerce platforms. Thank you. Okay. Here I no, I think it's the slide before. Andrea, sorry. Yeah. So two is the understanding the cross-border online purchases can now be classified into two schemes. So the first one is called CBER, the cross-border e-commerce retail import, which is the e-commerce in narrow sense within the meaning of law. So, and it's treated as general trade, as just mentioned. So, however, compared to B2B general trade, it can enjoy a duty exemption and the taxes reduction treatment. So later we will come back to the conditions to qualify for CBER and its tax regime. The second regime, as you can see, relates to those purchases that do not qualify for CBER. So these purchases remain to be treated as import of personal articles. Okay, so we'll go to next slide. So now we'll look at the CBER scheme. Here I have listed the main regulations in force, so we can just pass quickly. So Andrew, next slide. Thank you. So first question, what kind of purchases can be qualified for CBER? The typical one is the purchase through e-commerce platform that is connected to the Chinese customs system and is able to transmit in real time to the customs authorities all the information regarding the order, the payment, and the logistic flows called 3 flows. So far, this regime is limited to platforms that are owned and operated by Chinese companies. So the overseas platforms are not covered. Actually, from a technical and a compliance perspective, establishing and maintaining data connection to the Chinese customs system is extremely complicated work. So basically, only the large platforms are able to do that. So you may have heard some names like Tmall Global, belonging to Alibaba, and JD Worldwide, etc. So this business mode is currently the first choice of large foreign brands and sellers who want to sell to China online. And another CBER mode recognized is the purchase not through a connected platform, but the express or mail company is able to transmit the 3 flows on behalf of the foreign merchant. And this mail company accepts to assume the legal responsibility for the information transmitted. So actually, in our actual work, we have not yet dealt with this kind of case. I think it depends on the specific arrangement between the e-commerce company and the mail company engaged. And okay, so next slide. Thank you. Do that. So Andrea, can we pass to the next slide? Okay. So before selling to China under CBER, the overseas merchant, so the foreign seller, must entrust a representative in China, which shall be a company, and then get registered with the local customs authority through this representative. Another point to mention, the CBER import is administrated with the whitelist system. So only the goods on the whitelist are eligible for CBER import. So the current version has listed 1,500 commodities covering most of the popular products for the individuals' self-use. Okay, next slide. Thank you. So in this section, we'll show you how the CBER imports are taxed. Actually, there are 2 quotas to remember. So 5,000 RMB, equivalent of 600 euro for each single order, and 26,000 RMB, equivalent of 3,000 euro, which is the annual quota for each individual. So if the purchase does not exceed any of these 2 quotas, as you can see on the first line of the table, then you can enjoy customs duty exemption, and also the import VAT and consumption tax. You can also enjoy a 30% reduction, so only 70% will be taxable. Then if the purchase exceeds any of these 2 quotas, the law says that the duty and taxes shall be levied at the normal rate, and one must go through the customs declaration and the clearance as in the general trade. However, the general trade, as just mentioned, basically applies to a B2B import. So practically, it is impossible or very difficult for an individual like us to conduct customs formalities like import company. So how it works in practice, as I mentioned here in the table, if there's a single order exceeding the quota of 5,000 RMB, but there is only 1 article in this order, then the buyer can still place the order and make payment, but the platform will calculate and withhold the applicable duty and taxes from the final price the buyer will pay. So if the order includes more than 1 article, the platform will immediately block the payment, and the buyer needs to place several orders with each less than 5,000 RMB. So then it can work. The more problematic is the annual quota. Actually, when you place your first order on the Chinese CBER platform, you'll be required to enter your ID number and upload a scan or photo of your ID card. And the customs system will record and update the remaining annual quota of each individual. And the customs system will alert the platform as long as your annual limit is reached. And then you can no longer buy on these platforms in a given year, and you must wait for the next year. So as you see, if the quotas are reached, especially the annual quota, the order will just be blocked. So it is not just about, paying more duty and taxes. You just cannot buy. Okay, so the basis of the duty and the tax is the actual transaction price, including the retail price, shipping cost, and insurance premium. So thank you, Andreas. To next slide. So now we can see the rates of different taxes. So for the import VAT, for most goods, the standard rate in China is 13%, which can be reduced to 9% under CBER within the quotas. And for certain specific products, for example, books, it is 9% and it can be reduced to 6.3% on the CBER scheme. So it's relatively low. And then the consumption tax applies to certain luxury goods such as cosmetics and watches, jewelry, and to those considered harmful to health, such as wines, alcohols. So this tax is based on the sales amount or volume, depending on the nature of goods. Then in terms of tax payment obligation, as you can see in the case on the right side, so according to the Chinese law, on the CBER, the individual buyer is the statutory duty and taxpayer. However, as mentioned at the beginning, the platform enterprise, or in some scenarios, the mail company, is designated as the tax withholding agent, meaning the party who is responsible for calculating, declaring, and withholding the duties and import taxes. So failing to properly collect and remit the duty and the taxes, the authority will first reach out to the platform. And as withholding agent, the platform shall make up tax payments and it might also be imposed administrative penalties. So which concept is, I think, similar to the marketplace facilitator tax rule that is implemented in some of other countries. Okay. So thank you, Andrew, to pass to next slide. So now we have finished for CBR. Then if a purchase does not qualify for CBR scheme, for example, if I buy directly from an overseas platform like Amazon US, and which does not work with a connected Chinese mail company, and then this purchase will be treated in the same way as a C2C and subject to the parcel tax. There are also value limits set by law, which is 1,000 RMB for each parcel mailed from foreign countries other than Hong Kong, Macau, and Taiwan. For the three jurisdictions is 800 RMB. So the parcel exceeding the limit might be returned directly by the customers, except if there's only one article in this parcel and it is considered to be for the individual self-use. So the parcel tax has three categories, as you can see, and corresponding to the rates of 13%, 20%, and 50%. So actually, the parcel tax is a combination of the customs duty, import VAT, and consumption tax. So although the taxpayer cannot see this composition, actually there will be an allocation among different taxes for the purpose of public finances. And the parcel tax is not payable if the tax amount calculated is less than 50 RMB. And unlike the CBER tax, the parcel tax should be paid directly by the individual buyer. So if the parcel is caught in random inspection by customs, then the buyer will receive a message and be required to pay tax either online or on site in order that the parcel can be released by the customs. So, okay, so I think we are coming to the end. So due to time limit, I will finish my part now for China. And thank you for your attention. And I hope after this presentation, you have got a clear view of the e-commerce sales onto China. So And now I will give the floor to Christina Rinne, who will talk about the e-commerce tax reform and platform taxation updates in Switzerland. So thank you, Christina.
Thank you, Yijun. So let me introduce myself. My name is Christina Rinne. I'm a partner in the tax department of Niederer, Kraft, Frey. We are a Swiss law firm located in Zurich. This is the German-speaking part of Switzerland, and also in Geneva, the French-speaking part of Switzerland. And I'm specialized on indirect tax and customs. And today I would like to give you an overview about the status of e-commerce in Switzerland. So perhaps we go to the next. Yes. So very basically, I don't want to be too technically, but it is important also to understand the Swiss concept that with regard to the VAT treatment on the supply of goods, we have a default rule. That means the place of supply is where the transport begins. So if a shipment starts from Swiss territory, which is not only Switzerland, but also Liechtenstein, which is a different country, but we have a similar concept like in the EU, that Switzerland and Liechtenstein are building one single customs market. So if the goods are dispatched from either Liechtenstein or Switzerland, then they are subject to VAT. But when the transport starts outside of this territory, normally these supplies are not subject to Swiss VAT. However, there is a fictitious shifting of the place of supply to Switzerland in two cases. Either if the supplier has applied for import license, that means that he will be the importer of record instead of the recipient of the shipment. But he has to register for Swiss VAT purposes and has to account for VAT on his domestic supplies. Or if the supplier falls under the so-called mail-order company regime for small consignments. This has been introduced in 2019. And in order to better understand what these small consignments are from a Swiss perspective, I would like to go to the next slide to show you that Switzerland has really considerably low rates, also compared to China, but also to the EU. And this is insofar important as we go to the next slide, as the threshold for the assessment of import VAT is at 5 Swiss francs, which is pretty much almost €5 in the moment. So with regard to these very low VAT rates, it was possible until 2019 to order goods to Switzerland with the value of 200 Swiss francs if they are subject to the reduced rate, like books, for example, or for 65 Swiss francs for the regular rate of 7.7% formerly. Now we have 8.1%. And this was very convenient for the customers because they didn't have to pay import VAT only if this threshold was exceeded. And this led to a huge gap in taxation, and therefore the Swiss government has decided by introducing a special regime in 2019. Next slide, please. There it was said, and it's also written in the Swiss VAT Act, that the place of supply is moved to Switzerland if the merchant achieves a turnover of 100,000 Swiss francs with these small value consignments. So this will be monitored via Swiss Post when the packages are being imported or in the import procedure. And once this threshold is exceeded, the respective merchant is liable to register for Swiss VAT and to account for VAT on all his supplies, because there is no distinction anymore than with regard to the small shipments below the threshold or above the threshold. However, a significant share of consumption still remained untaxed because either the foreign suppliers didn't exceed the threshold or they exceeded the threshold but did, however, not register for Swiss VAT, or there was tax avoidance because there were incorrect values indicated for the import procedure. And in order to close the gap, Switzerland will introduce a platform taxation as from 2025. Next slide, please. So here on that slide, I really just show you the very basic concept that the platform will be included in the supply between the merchant and the customer. So it's regarded as a reseller. And that means that the platform will need to register for Swiss VAT if the turnover of 100,000, not only for small consignment, if the turnover of at least 100,000 of supplies of goods to Swiss territory is accepted. And this will, as I said, only be for the supply of goods, not yet for services. This is also envisaged to introduce, but at a later stage. So on 1st January, we only have the platform taxation for the supply of goods. So next slide, please. Which platforms are affected? There is a definition in the Swiss VAT Act, and I have put some of the most important rules from the Swiss VAT Act at the end of the slide. So I will not read them with you now. I just want to provide you also with some information on the legal text. But a platform is regarded or is in the scope of the platform taxation if it facilitates the provision of a supply of goods. So it brings together sellers and buyers with the aim to conclude a contract. So next slide. So a platform will not be considered as a deemed supplier if it meets at least one of the following conditions. It does not participate either directly or indirectly in the order process. It does not generate any turnover in direct connection with the transaction, which is particular the case when it's only involved in the payment, or if it only provides advertising services, then these service providers or these platforms are not affected. And in the next slide, I would show you the basic concept of the default structure. Perhaps you can also shift the arrows all on so that one more. Okay, thanks. Here you can see that we have a foreign supplier. He's not VAT registered, and he does not need to be VAT registered. Even though there is a direct shipment from outside of Switzerland to a Swiss recipient, the platform will now be regarded as if it's a reseller. So it procures the goods from the supplier, and this is a deemed supply. And by introduction of a specific provision in the Swiss VAT Act. This will be a zero-rated supply. That's why the supplier does not need to register for these kind of supplies, and the platform will import in its own name, and it will also issue for the purpose of civil law invoices for the supply to the Swiss customer in the name and in the account of the seller. But with regard to VAT, the platform issues the invoice in its own name. So the platform has to account for VAT with the Swiss tax administration on these supplies, and there are many aspects that need to be covered. Also, in specific constellations, if it's B2B or B2C, because also this is all possible, and there are specific issues in each scenario. And in the moment, the only thing I can say to you here that there is currently the Swiss VAT Act has been approved, so this will come for sure. And currently, the Swiss VAT Ordinance is into consultation with the government, and it is expected to be finalized and approved in September this year. But based on the consultation so far, I heard that there might be a potential alternative. Can you go to the next slide? Also with the arrows, please. The difference is marked in yellow. So here, for specific scenarios, it might be beneficial for the supplier to opt for Swiss VAT. That means that he can issue an invoice with Swiss VAT to the platform. And the VAT treatment of the platform is still the same. The platform has always to issue the invoice to the recipient and has to account for VAT on this supply. But in this alternative, the supplier might be entitled for input VAT deduction of special schemes which are introduced in Switzerland if the goods are procured from private individuals or non-VAT registered persons. Then we go to the next slide. There is a special regime that will be introduced or that will be open for platforms, a deferred import VAT scheme, which entitles the platform or enables the platform not to really pay the import VAT, but to account for VAT just at the customs clearance and then also in the VAT return, so that it's a cash flow benefit. It's similar to the Article 23 procedure in the Netherlands, some of you might know. And this is only possible to apply for this special scheme under specific conditions, but it will be then, if it's applied, it will be applicable for the deemed supplies as a platform, and if the platform is a supplier himself or itself, these supplies can also be, or the imports can also be conducted via this deferred import scheme for the platform. Next slide, please. Again with the arrows. So this is a provision that was already in the draft ordinance, and it is very likely that this will be possibility will be introduced. Here, the difference to the first two slides I have shown you is that the supplier can act as importer of record, so he can pay the import VAT but still the supply to the platform is zero rated, and the platform is still liable to account for VAT on the client facing leg. But this gives some flexibility to the supplier if they have perhaps different warehouses, different dispatch places, or if they are distributing their goods via different platforms. So this provides much flexibility how to treat the imports for the platforms. And lastly, I would like to come to administrative measures on the next slide, because this is something Switzerland was very keen on, that in the event of non-compliance, that the authorities can really impose administrative measures. First, they can put an import ban on the consignments. And if there is still non-compliance, they will be also entitled to destruct the shipments, the parcels after the customs clearance. And in addition, it is also envisaged to introduce a blacklist on the website of the Swiss Federal Tax Administration. That means all the platforms that are not compliant will be listed, and this will be in a officially accessible site where you can see who is blacklisted there. So from the legislative timeline, we are in the middle of waiting that the Swiss VAT ordinance with these two alternatives will be approved in September. And also currently we are waiting for the Swiss VAT authorities to draft the new practice about the new legislation. And it's being scheduled to be published this month in June. And now the next slides are just the legal background for you all. And I hand over to my colleague Christian from Germany. Thank you.
Many thanks, Christina. And good morning and good evening to everyone. It's a pleasure for me to present the German part, actually EU part, but of course, as I'm a German lawyer and tax advisor, it's specifically the German perspective that I can present to you. Nevertheless, of course, the structure, the concept is the same all over the EU. I will spot the following issues. First of all, I'll give you a short insight into the legal framework. Then we'll have a short look at the concept of distance selling in the EU, especially when it comes to reporting requirements. And as a second part, I'd like to say a few words about non-EU distance sales with the so-called import one-stop shop, as well as the deemed reseller model that is applicable to platforms since 2 years. And finally, I will conclude with a short look into additional reporting requirements and, of course, a short outlook to what can be expected in the next couple of years. Talking about the EU means, and VAT especially, of course, means that we have to keep in mind that VAT is a harmonized legal system in the EU. So we have a legal framework given by the EU in the form of directives and regulations, and we need some sort of implementing act by national legislators into the member states. And that always leads to slightly different rules because the legal framework leaves some decisions up to the national legislature. And of course, sometimes the national legislators just do not fulfill the requirements given by the EU. So we always have to have a closer look into the specific rules in the various member states. Having said this, we move on to the concept of distance sales within the EU. We are talking about distance sales in the EU when goods are supplied to a non-taxable person, and the goods are either shipped within the EU from one member state to another member state, or from a non-EU country to an EU member state, and the goods are shipped by the supplier, by the seller. As a consequence, these supplies are taxable where the recipient of those goods is established where the shipment ends. And can you please switch to the next slide, Andrea? For whatever reason, that doesn't work. Okay, perfect, thank you. That leads to an obligation to VAT register for suppliers in the various member states where they are shipping the goods to. And of course, this is associated with high costs. In the past, of course, distant sellers had been registered in up to 26 member states, which is actually ridiculous. And so the EU Commission started an initiative on applying a so-called one-stop shop that helps you as a supplier to file only one VAT declaration in one member state, including all the data and taxes that need to be collected in all the member states, in some kind of centralized reporting concept, and the competent national authority then forwards the information and also the funds that are collected by these offices to the competent national authorities of the other member states. This concept of a one-stop shop would seem to be one unique platform, but that is unfortunately not the case. We have at this time various one-stop shops, and there is one for EU distance sales. There is one for non-EU businesses rendering services to EU consumers, especially when talking about electronic services. And we have one-stop shop for non-EU distance sales. And this is the part that I'd like to focus on. We are talking about shipments with a value of consignment below 150 euro. And in that case, the import one-stop shop can apply. It is not necessarily applied. You can also, as a non-EU based business, simply import the goods into the EU on the, let's call it, ordinary, well-known way, and afterwards distribute your goods. Or if you'd like to, you can fulfill conditions for the import one-stop shop. And what's the benefit out of this? That is what I will show to you later. But before doing so, please let me also highlight that this concept of a one-stop shop is only applicable if you only are carrying out taxable supplies that are in that framework of a one-stop shop concept. So if you do render various other taxable transactions, for example, local supplies within the member state that need to be declared, this type of transactions cannot be included, unfortunately, in the one-stop shop reporting. What are now the rules for import one-stop shops? The rule is actually, as I already mentioned, that the consignment value should be below 150 euro. And this is because we also have a threshold of 150 euro for the accrual of customs duties. So as long as the consignment value is below 150 euro, no customs duties will accrue. That is the reason why this threshold is also applied in terms of VAT here. And in addition, you have to register separately with, in Germany, the Federal Central Tax Office to get an additional identification number. This is an identification number that is different to a VAT identification number, and it is crucial to quote this ID number in the import declaration. And please also note that the low value consignment relief with regards to import VAT with stipulating a threshold of 22 euro has been abolished in July 2021 because of the VAT gap that was identified, especially in connection with the goods shipped and imported from abroad into the EU without import VAT becoming due. What is the consequence if you use that concept of IOSS? The import can be zero rated if you make use of that IOSS by quoting the ID number in the import declaration, and this is approved by the customs authorities checking your import declaration. That is the same for businesses that have to appoint a representative. So in that case, the representative will file the import declaration and needs to be identified by this additional ID number. The consequence for the actual supply to the consumer is the same like you would have an intra-EU business. The supply would be taxable where the goods are shipped to, so where the recipient actually is established within the EU. And this type of transactions, of course, is then jointly declared in only one declaration to be filed in the member state of registration. That is the one option for those businesses established outside the EU, or also for EU businesses in the member state of establishment. The OSS declarations have to be filed on a monthly basis, and EU businesses can file these reports on their own. However, non-EU businesses need to appoint, as already mentioned, a representative that is acting on behalf of the representative company, and this representative needs to be established in the EU. There is also a concept of whitelisting for non-EU based businesses, but at this time only Norwegian EU businesses can import goods by using IOSS into the EU without a representative. So this brings me to the deemed reseller model, as a concept that has already been discussed and introduced by Christina, the concept is more or less the same in the EU. However, this already applies since now nearly 3 years. What are the conditions for the application of that deemed reseller model? We have a shipment from a non-EU country with a maximum value of 150 euro, or we have a distance sale of goods within the EU, but the seller of the goods is not established in the EU. So actually 2 different scenarios, and what they look like and what the consequences are is described on the next slides. First of all, goods are shipped from a non-EU country, for example, China, to the customer, the consumer in the EU. The value of the shipment is below 150 euro. Then the platform, the digital platform that is facilitating this business is deemed as a reseller in the supply chain, and that leads to, of course, consequences in terms of VAT. And the first consequence is that the reseller or platform is liable for VAT in the country of destination. And secondly, as the IOSS is being used, of course, there is no input VAT due. This is more or less the best benefit out of it. Of course, it's no question that there are huge challenges for platforms to handle this in terms of what is the right VAT rate, what are the goods actually classified under with regard to customs classification, and so on. So this is really a huge struggle, but one benefit out of it is that there is no import VAT. The supply rendered by the Chinese seller or the non-EU seller is that this supply is deemed to be outside the EU, and so there is no VAT liability in the EU. Second scenario, a shipment from of goods within the EU from one member state to another member state, for example, from a fulfillment center and in France to Germany, and the seller is located, established in a non-EU country, for example, China again. More or less the same happens without that threshold of 150 euro. The platform is deemed to be a reseller in that transaction, meaning that it will become liable for the VAT in the country of destination and needs to or is eligible to report these transactions in the one-stop shop if possible. And the transaction or the supply rendered by the seller is zero rated or VAT exempted, so that there is no VAT liability in the EU. Again, however, of course, technically, we cannot say this is out of scope of the European VAT. Along with the deemed reseller concept comes additional reporting requirements, which is called DAX 7. This is regulation that makes it necessary for platforms to report additional information and data concerning both the platform and the seller to the authorities. And of course, the background of it all is transparency, the avoidance of tax evasion, and the opportunity to give more control to the tax authorities throughout the EU by comparing the data that is collected from the platforms. There is only a standardized technical concept, which type of interface needs to be used, and for electronic filing, of course, and there is no harmonized definition of which data and information shall be collected. This is only done on a national basis, and we need to see in the near future how this works when it comes to a comparison of data that is collected in France, Germany, and other EU member states. But needless to say, this is, of course, again, a huge hurdle for platforms and a big challenge to get this in place and file this compliantly. There is, as talking about GDPR, for example, also restriction for including data in that report that should not be included. So you should be aware of that limitation. It's not a good advice or idea to collect and include as much information as possible in that report. It might also be a breach of the law if you do that, although you shouldn't have done it. And this could also be fined. What's next with regards to the VAT? In the EU, there is an initiative driven by the EU Commission that is called VAT in the Digital Age, that has major changes for VAT in scope, but of course also with regard to the deemed seller model that should be expanded to short-term accommodation, rentals, and passenger transport. And what is not mentioned here, along with that VAT initiative. There is an initiative for reforming the customs law by, for example, abolishing the threshold of 150 euro. And that, of course, will again have effect on the VAT rules when talking about import one-stop shop. It actually should come into force July 2027. However, the last attempt to pass that initiative was stopped by Estonia, challenging exactly that expansion of the deemed reseller model. There shall be one more attempt before the summer break, somewhere around end of June. So maybe Estonia is convinced then, or can be convinced, and so it's only 3 years' time to get prepared for the new concept. Having said this, I thank you for your attention and give the floor back to Paul.
All right. Thank you, Christian. With the time that we've got left, we're going to undertake sort of a necessarily brief overview of the modernization of Canada's various sales taxes, value-added taxes designed to deal with the massive increase in e-commerce transactions over the past decade. I'm going to focus on these taxes from the perspective of non-Canadian sellers engaging in e-commerce transactions with Canadian customers. I'm going to deal with the broad thresholds. Oh, sorry, my slides are not advancing. Andrea, can you advance to my first slide, please? Thank you. So I'll deal with the broad threshold issues that the non-Canadian sellers are going to need to investigate to determine whether or not they're going to need to register and comply. And we'll also talk a little bit about the taxes themselves. I guess to begin with, you should know that Canada has a number of taxes that are implicated in e-commerce transactions. We have a federal value-added tax that I'll refer to as the GST. It's imposed across the country at various rates. We have a provincial value-added tax that's imposed only in the province of Quebec. That's the QST. And we have three provinces that have provincially imposed sales and use taxes, similar to a US-style state sales tax. So we kind of have the best of all worlds. We're also on the verge of implementing a digital services tax that's going to impact on large businesses engaged in certain e-commerce businesses in Canada. But for today, we'll just restrict our discussion to the sales, use, and value-added taxes in Canada. Now, all of these taxes have undergone significant changes over the last 5 years to modernize them, to help them better deal with taxation of e-commerce transactions. We can flip to the next slide, please. So prior to 2019, each of these taxes did apply to certain e-commerce transactions, but not really in any sort of efficient or effective manner. Both the GST and the QST have always applied generally to all forms of e-commerce because the tax base includes the taxation of both services and intangible property. But the rules only apply to e-commerce sellers that were either Canadian or, if for non-Canadians, if they were carrying on business in Canada. Now, this carrying on business threshold requires a significant degree of connection to Canada. And so for these non-Canadian e-commerce sellers, those who their only connection to Canada was having a series of customers buying either intangibles or services that were being supplied electronically, there wasn't going to be a requirement for the sellers to become registered under the traditional rules. Now, that's not to say that there was no tax imposed on the import of such intangibles or services, but because that tax was imposed by means of a self-assessment requirement on the purchasers, it's clear that consumers engaged in B2C e-commerce transactions certainly weren't going to be assessing GST or QST when they paid Netflix for their membership fees. And frankly, even if they had, it wouldn't have been an efficient manner for the tax authorities to audit such compliance. And as it relates to the three provincial sales taxes, they've always been more limited in what was taxed. They applied primarily to tangible personal property and really only a specified list of services and intangibles. So although the tax base expanded over the years, it wasn't until the last 5 years or so that they truly became more effective at taxing e-commerce transactions. Similarly to the GST and QST, most non-Canadian e-commerce sellers would rarely have been required to be registered as a tax collector under the traditional rules. And again, self-assessment obligations were often not satisfied by the purchasers in the jurisdictions. And again, it wasn't an efficient way for the tax authorities to conduct audits in terms of looking at sort of each consumer and a failure to self-assess the tax on the import of a taxable, whether it's a service or intangible. And so starting in 2019, the provinces and the federal government began to modernize the various sales tax regimes, creating much broader and more efficient systems, both for the collection of tax on e-commerce transactions, but also the auditing of such tax collection. So you'll see briefly on this slide and the next that each of the jurisdictions created slightly different systems. But in general, in all cases now, non-Canadian marketplace sellers, platform operators, and in some cases, platform or marketplace facilitators were going to have to determine whether they needed to comply with the new rules to collect, report, and remit sales taxes in respect to the e-commerce transactions that they were engaging in with Canadian customers. If we can flip the slide, please. The most significant change came in July of 2021. That's when the Canadian federal government created the new simplified GST regime, which was designed to bring a much larger and broader group of non-Canadian sellers into the Canadian tax net. Can we flip again? And so let's start here with a discussion of the federal value add tax, the GST, because this is really the only Canadian tax that's always going to need to be considered when you're engaging in e-commerce transactions with Canadians. The other taxes that we'll talk about, and frankly, I don't know that we'll have time to talk about them today, but they only really need to be considered in circumstances where there's sufficient connection with the provinces that impose those taxes. So, as we noted, the key amendments to the GST legislation came into force on July 1st, 2021. And so in looking at this, you're really going to need to go back and consider whether these rules would have applied to you or your clients and their e-commerce sales into Canada as of this date. So in general, these amendments were designed to broaden the registration and collection requirements, really to include the non-Canadian sellers that are not carrying on business in Canada and therefore wouldn't be required to register under the traditional regime. There are a number of primary targets for this amended legislation. So platform operators that operated digital platforms that allow non-Canadians to sell intangibles or services to Canadian customers. We've got platforms that allow some Canadian and then non-Canadian sellers of some tangible personal property in certain circumstances on sales to Canadian customers. We have these short-term accommodation platforms in respect of either Canadian or non-Canadian suppliers where the accommodations are located in Canada. But lest you think that this is simply a new platform tax, the legislation is actually much broader than this, and it targets all non-Canadian businesses that sell either intangibles or services to Canadian customers. It's actually also important to note that we're not really only talking about e-commerce transactions either. Yes, of course, sales of software and media and online memberships are all covered, but more traditional services that can be sold from abroad, advertising, legal services, accounting services, these are all actually caught by the legislation changes as well. Can we flip to the next slide, please? And so, although this new federal legislation was clearly designed to broaden the registration requirements to capture non-Canadian e-commerce sellers, it certainly wasn't designed to capture all non-Canadian e-commerce sellers. And there are a series of exemptions and exceptions that may apply to limit the number of new registrants into the system. The first exemption is the $30,000 per year minimum threshold for sales to Canadian customers. So any non-Canadian businesses with only small sales into Canada, they don't really need to worry about registering under the simplified regime. The $30,000 threshold is also important when considering the general exemption related to the sale to Canadian customers that are themselves registered for GST purposes. Now, without getting into too much detail, the new regime is really not designed to require the collection of tax from a Canadian customer that's registered for GST purposes. And so for non-Canadian sellers that sell only to GST registered businesses in Canada, again, there isn't going to be a requirement to collect tax from Canadians. Now, one quick caveat here. Although this exclusion from collecting tax from a GST registered purchaser may make this seem like a regime that is only designed to apply to B2C transactions, That's actually not the case. And it's not the case for a number of reasons, but the biggest is that not all businesses in Canada are required to be registered for GST purposes. And so even in a fully B2B context, these new rules may still require a non-Canadian seller to register and to collect the GST. Another key exemption available is that non-Canadian sellers that are already registered under the traditional system aren't required to comply with the new system. And although this may seem obvious, it really does allow for the non-Canadian sellers to effectively choose whether they want to voluntarily register under the traditional system or whether they want to register under the new system. We certainly don't have time today to talk about all of the sort of ins and outs of the new system versus the old system, but I can tell you that I often recommend a traditional registration for non-Canadian e-commerce sellers because of difficulties with this new system, even if they aren't required to register under the old system. So I see that we're already out of time. And so let me tell you the three key considerations. This is the takeaway, I think, for anyone who has to leave on time, is if you're a non-Canadian selling services or intangibles into Canada, what you really need to think about is, one, are we caught by the new rules by virtue of what we're selling to Canadian customers? Second, if we are within the scope of the new rules, are we somehow exempted, either because our sales are too low or because we can prove that all of our Canadian customers are registered for GST purposes? And third, if we're not otherwise exempted from the registration and collection requirements, do we want to choose to become registered under the traditional system or under the simplified regime? So given that we're out of time, I will continue for a little bit longer, but let me say thank you to those who have to leave on the hour. But for the rest of you who can stay, why don't we quickly turn to some of the key tax obligations that are going to exist for non-Canadian businesses that have either registered to collect the GST under the simplified system or under the traditional regime. Now, as we've touched on, the specific obligations and the specific rules that need to be followed are going to vary depending on which regime the seller has registered under. But in general, a number of things are going to be true. For platform operators, whether it's accommodations in Canada that are being supplied or whether it's intangibles or service that's being supplied, the operator is generally going to be required to collect tax from the Canadian customer in respect of all the sales that are made via the platform. Now, there are some key exceptions that can complicate matters, but that's generally going to be the case. The operator is then going to need to report and remit the tax to the tax authority. They're going to need to determine whether they need to collect tax on any services that they themselves as the platform are supplying to the marketplace sellers. And then for all of this tax collection, the platform operator has to determine which of the rules or which set of rules to apply to determine the appropriate rate of tax to collect. They need to determine what details need to be provided to the customers on the invoices and whether it itself is entitled to claim any tax credits in order to recover its own GST expense. Certainly, it's a fairly significant list of tasks that the platforms are going to need to complete in order to ensure compliance. For non-Canadian sellers that are not selling through a platform, they have to engage in virtually all of the same tasks. But for non-Canadian sellers that are selling through a platform, as long as they're selling through a properly registered platform, they're generally going to be absolved from any of the requirements to register, collect, report, remit the taxes. Now, obviously, this is just a very brief discussion of the GST issues facing non-Canadian e-commerce sellers as they start to make sales into Canada, or frankly, continue to make sales into Canada, not having looked at the rules in the past. There are lots of potential traps, planning strategies, other difficult issues that we simply don't have time to talk about today, but they do need to be considered by any non-Canadian that's going to be selling any type of goods, but in particular under the new rules, intangibles and services to Canadian customers. We're not going to be able to talk today about the changes to the sales and value-added taxes imposed by the provinces of Quebec, British Columbia, Saskatchewan, or Manitoba. For now, the key takeaway is really that if your e-commerce customers include either businesses or consumers located in any of those four provinces, you will need to undertake a separate review of the laws and policies to determine whether or not registration and compliance is going to be required. The rules are all different, and even where they look the same, there are often small changes that can be the difference between a requirement to register and no requirement to register. And with that, We've reached the end of our presentation today. I'd like to say a quick thank you to my co-speakers for all of their interesting comments, and to all of you for joining us here today. And please stay tuned for the GLCA's next webinar that's coming up later this year. Thanks, everybody.